Good evening, everybody. It's great to be back here. I think I was here a couple of years ago. So some basic facts. Impax Asset Management Group PLC is quoted on AIM. Ticker is IPX. Market cap is just less than £400 million. The website is impaxam.com. So lots of information there in the usual fashion. I started the business in 1998. I own about 7.5% of the shares. I've never sold a material amount of shares. So I've been there for 20 years. The management team owns about 30% of the business. Now, investment management has had a bit of a bad press recently, particularly the FT has been pursuing one unfortunate individual. What I'd like to do as I go through my 25 minutes or so is to draw out some of the reasons why Impax is a very resilient business in the context of some of the criticisms that have come out about the industry in recent weeks. So without further ado, then investment management really is an increasingly competitive business. And to be competitive, you really need, as a company that's not called BlackRock or Vanguard, to differentiate yourselves. And Impax differentiates itself in a very specific way in that we are focused on an investment philosophy that we call the transition to a more sustainable global economy. Now, I'll explain a bit more detail what I mean by that, but essentially this is a set of economic drivers linked to the idea that as the planet gets increasingly populated, people move increasingly towards the cities, demand higher and higher standards of living, and are polluting their environments, consuming natural resources. There are strong reasons why certain businesses linked, for example, to environmental quality improvement, to improvements in resource efficiency, and dealing with new opportunities linked to technology to provide healthcare, financial services to growing populations, are really well placed to outperform relative to global indices. And because those industries are complicated, there's lots of technology change, there's lots of regulatory change, there's lots of young companies that are going through M&A. There are opportunities for specialist individuals who've got skills in science, engineering, economics, how certain industries work, and of course generic fund management to come together to unpack where those valuation anomalies lie in these industries and to run portfolios which capture the best of the upside potential while still managing risk effectively. So that in a nutshell is what Impax does. Now today, or the end of March rather, which is the end of our half year because we have a September year end, we posted £13.3 billion under management. At the end of May, that had grown to £13.6 billion. And the breakdown, according to the donut there, shows that 3/4 of our assets under management are in what we call thematic equities, which is those businesses that are very or more narrowly focused on the environmental sector. We, for example, run an investment trust called Impax Environmental Markets, which has a market capitalisation of just over £500 million, which is in that group of assets. We have a small private equity business in the real asset space, and most of the rest in the light blue is money managed from an acquisition we made in January 2018 of a money manager in the United States on the East Coast called Pax World Management, who are very closely aligned with our investment philosophy, but run assets particularly in fixed income and smart beta, which we hitherto have not been doing. And therefore, the acquisition, as I'll explain in a bit more detail, has given us additional product for our shop window to be able to reach our existing customer base with new products, both stateside, which is about 40% of our assets under management in total, and also around Europe and Asia. So as somebody said recently, this is the story of your life for the last 20 years in snapshots every 12 months. So the assets under management of the company for every year since inception. So we started off with a $25 million account from the World Bank to run a solar energy fund, £15 million back in 1998. And you can see that we've weathered a number of financial crises relatively well. So in particular, 2001, 2002, which was the end of the tech crash. And then, of course, 2008, where fortunately, given our September year end, the real dip, which happened in the sort of October to December time period in the UK, was masked by the leap to September 2009. So a very resilient business, gone through a couple of major challenges and obviously substantial growth, particularly in the last few years when not only have we brought in the Pax acquisition, but we've been bringing in around $2 billion US of new money from clients around the world. As I mentioned at the outset, then the investment management industry is increasingly competitive, and I think it's fair to say that there is a split going on at the moment, a bifurcation, if you like, where the larger groups are struggling, fighting to get to a magic number, which appears to be about $1 trillion under management. So if you're in that $100 billion to $700 billion under management range, which is most of the well-known brands in, say, the European market and many US brands, you're really fighting to try to get to further scale, because otherwise you're not going to be able to compete on price with Vanguard, BlackRock, T. Rowe Price, and a number of others on a global basis. That's one part of the market, and everyone's talking about the move to passive, which is sort of where that group is heading to a significant degree. Now, the other part of the market, which is where Impax is really fighting very effectively, is in what one might call boutiques, which are those specialist investment managers with a differentiated offering. They're best in class on a global basis, doing something which asset owners are particularly interested in, and which over time is generating the track record that suggests that it's better to pay fees for active management in that specialist area rather than just go passive. So in that sense, Impax is well placed for quite significant further growth from our £13.6 billion, which is about $17.5 billion, to scale up twice, 3 times the size, and we're still within the range in which boutiques can, in theory, operate quite successfully. Now, what are we seeing in terms of the transition to a more sustainable global economy? Well, there's different ways of representing this, but in the thematic equity area that we're investing in, then we talk about 4 types of industry: clean energy, water, waste and resource recovery, and sustainable food, agriculture and forestry. The classification of those is well documented by FTSE Russell and a number of others, and it encompasses around 25 industries, for example, energy efficiency, pollution control linked to the transportation sector, logistics and improved packaging, food safety in the agriculture and food space. There are a very significant number of large and rapidly growing markets here. So as we look, for example, at the power sector, then for the last 10 years there's been an enormous opportunity to invest in the construction of wind farms and solar farms, particularly in Europe and North America. Now there's so much renewables on the system that the only way to get a lot more is to invest in storage, in interconnection, and in the smart grid. So we've had one revolution for the last 10, 15 years or so. We're now in the early years of another 15 years of integration of a lot more renewables, as coal plants, as we heard from a previous speaker's Q&A, are under pressure in Europe, and there is also questions around whether the nuclear sector can continue to build assets at an attractive price. A lot of other opportunities, for example, in the water sector, where we're seeing that technology that works at a small scale in one country that solves a particular pollution reduction or quality assurance problem, for example, in the food sector or the healthcare sector, can have a global marketplace if it teams up through M&A or through some kind of joint venture with a marketing and client service platform, potentially a large industrial company, not necessarily in the water sector. If you invest in the water technology provider at the right point, you can see a very significant multiple on your share price just through that business integration, because the demand for water globally is based on some very constant human physiology around the world. In the food sector, 30 to 40% of food is wasted between the field and the fork, and that's a huge amount of opportunity for efficiency around smarter logistics to deploy seeds, water, fertilizer, and pesticides using ground truth and satellite technology, which is a high-tech solution, all the way through to smarter control and instrumentation around logistics and distributing, for example, soybeans in the middle of Brazil to the Brazilian ports, which can lead to up to 50% wastage, and then all the way through to smart packaging in your supermarkets. So I'm trying to give you a flavour of the type of industries that Impax is particularly interested in, and I'm sure you know enough about these sectors to have a sort of intuitive feel that there's the complexity around technology, regulatory change, and M&A should be a good hunting ground for specialist managers to do their job and find uncovered gems. On a narrow definition of the universe here, so requiring at least 50% of companies to be in those 4 sectors that I've 50% of a company's revenue to be in those 4 sectors that I've just described. We initially started with 250 eligible companies, and that's grown to 1,100 by 2018. And if you relax the 50% revenue threshold down to 20%, you add another 400. So in that thematic equities range, 3/4 of our assets under management, we've got a universe of about 1,500 stocks. Now, you may say, well, that's not very many, is it? But actually, every global equity manager has to find a way to get from 60,000 stocks down to around 1,000, 2,000 from which to start their stock picking. Otherwise, they don't have an ability to put a systematic process in place. Most global equity managers use financial screens, earnings momentum, for example, but those financial screens are almost inevitably short-term, 1 year ahead. But 1 year data doesn't really give you any indication of what a company's prospects are for the medium term, which is where real value can be created. So this fairly crude screen historically is given as a very strong driver for or indicator for companies which are in markets that are set for superior rates of growth. Who are our clients and what sort of conversations are we having? Well, as you may know, if you're in this industry, then there are a large number of asset owners around the world, public pension plans, sovereign wealth funds, families, charities, endowments, who are asking questions or being asked questions by their stakeholders of what is the purpose of their capital, to what impact are they having on their communities, on the environment, and what are they doing to help improve society. This is a conversation which I participated recently in Sacramento in California, where we've just won a mandate from the California State Teachers Pension Plan. I was out in Japan a month ago, where the government pension fund of Japan, the world's largest pension fund, is pushing aggressively in the direction of looking at better governance of the companies that it's investing in, or the managers that it hires. So the global conversation around these environmental, social, governance and non-financial factors is gathering pace. Now, although Impax is not here to save the world or to produce non-financial benefits, we're here to make money for our investors and in so doing make money for the shareholders in the management company, we are able to produce some quite interesting non-financial output metrics. And this is one. So for example, if you take the metric of climate change, which is the intensity of carbon dioxide emissions. So taking the world's CO2 emissions and dividing by the world's global savings, very crude way of carbon intensity, you get a bar, which is the one on the left. That's tons of CO2 for $10 million investment. To stabilize the climate at no more than 2 degrees temperature increase relative to pre-industrial norms, we need to halve that number. So that's what the Paris Agreement is all about, and the talk about climate change, net CO2 by 2050 that Theresa May announced a couple of weeks ago. Now, our small cap strategy, Impax Environmental Markets, is well placed to make quite a big contribution to that. So I don't have time to go into the details, but I'm trying to give you the impression that, or the sense that we have quite a number of interesting ways of responding to these non-financial questions that key clients who are able to allocate hundreds of millions of dollars to money managers that they think can add value to their process see from Impax when we pitch. Unlike many investment managers in the listed space in the UK, we have very limited exposure to the UK. Now, that's not because we have a particular view on the UK. We're just seeing an enormous number of opportunities, both to win clients and to invest capital overseas. So more than 90% of our clients are based overseas, and more than 95% of our assets are invested overseas. And this is the snapshot of the business today. So we have 5 offices, 3 in the US, London and Hong Kong for our 150 staff. We have distribution partners in throughout Europe, in Asia, and we have direct sales teams in the US and in the UK. We are invested in countries across this spectrum. In listed equities and in private equity, we're invested just across Europe. So this, in a way, is an international business, almost a global business today, and that does give us a really nicely diverse client base. So our largest client represents less than 5% of our assets under management, and therefore that sort of concentration risk that's been part of the problem with certain fund managers recently is not a problem that we suffer from. Highlights from the first half of 2019, well, I think the rate of inflows for assets under management for the firm remained very strong at nearly £900 million just in the first half, we've had very strong investment performance across the board, particularly in what we call a global opportunity strategy, which, unlike the thematic equities that I've been talking about, is a more unconstrained global equity strategy linked to a wider set of opportunities around sustainable development. What's particularly interesting about that is that we seeded it nearly 5 years ago, and after 3 years, it was identified by St James's Place, who were doing a global search for a new manager for the Aberdeen Ethical Fund that they had on their platform. They wanted a new manager. They used a couple of consultants to do a global search for a new manager, and Impax came out top of that list, and we were awarded a mandate of about £300 million by St James's Place back at the end of last year, when really we had no institutional business for that particular strategy. Since then, the sort of quality of the St James's Place diligence process has encouraged other clients to come forward, and we're seeing a very strong pipeline for global opportunities. Incidentally, £300 million in the context of a business of £13.6 billion is tiny amounts. Our exposure to St James's Place relative to the exposure of other managers, that should remain nameless, is low. Incidentally, we don't really have any material business with Hargreaves Lansdown either, which is I just point that out in terms of fact, because we've not really focused on UK distribution, really because we've had better opportunities elsewhere, and up until recently we haven't really had the clout, the scale to be of interest to a big UK retail platform. So that might be a direction of travel, but just in case you're sort of interested in sort of calibrating Impax, then we don't have any material business with them either. Just a quick review of the financials. So revenue run rate at the moment is about £72 million. Obviously, the revenue that we collect is based on the monthly management fees over 6 months. That's what these H1 numbers relate to. And our operating margin at the end of March on a run rate basis was about 26.5%. So I'll leave you to do the calculations, but we've had a very strong dividend history, which is shown here. So we initiated a dividend in 2008 and an interim dividend in 2014, and we've been able to meet our pledge of having a progressive dividend policy ever since. The 1.5 pence, of course, is quite a significant increase, 36% increase, I think, on the first half dividend from the previous year. So we're marching up the dividend. I think we do have scope to increase the dividend significantly in the future, particularly as we pay off the debt that we assumed for the PAX acquisition. The PAX acquisition, we agreed a valuation of $52.5 million for that business. We bought 83% of the shares up front, and the rest we're going to buy from management at the end of 2020 on an agreed formula. We took on board $25.5 million of debt from Royal Bank of Scotland to make the acquisition. Most of the balance consideration came from cash. So we were able to increase our run rate EBITDA by 43% with a 2% dilution to equity. So that was a significant factor in a strong jump in the share price when we closed that transaction. Transaction integration is going very well. So we're integrating the support teams, meaning the back and middle office, legal, compliance, HR, etc. The client service and marketing teams are being partially connected, particularly with an overarching committee. And on the investment side, then the investment teams are coordinating, but we're not changing any investment processes. Now, the reason that we're confident that the success of that acquisition will continue is that we've known the business and the individuals in that business for 10 years prior to making the acquisition, because we'd partnered since 2008 to set up and grow from $1 million to $800 million a mutual fund on the PAX platform that Impax had been sub-managing. So huge number of connections and relationships across the firm before we agreed to tie up. I'm very pleased to announce that, or report that no one's left the business of their own volition since the transaction was consummated. Actually, no one's left because we've asked them to leave, which would be the other reason. So we've not made any cost savings as a result of the acquisition. The acquisition was premised on the idea of cross-selling and teaming up for further growth rather than cost cutting. So I'm just conscious of time. I should probably wrap up. Shareholder Register, as I said, management owns 30% of the shares. BNP Paribas Investment Management, or Asset Management rather, it owns just less than 25%. of the shares. They are a big distribution partner for us across Europe and Asia, and the rest is free floats. There are a number of institutions that are above or below the 3% threshold. Fidelity has been above 3%. I think they sold down recently to below 3%. All that's obviously in the usual sources of data for you to uncover. But I think a number of people in the room have been owners of the shares, and we really value individuals owning the shares because we find that that's particularly helpful to create liquidity and a sensible share price. So appreciate all your support over the last few years. I think that's probably the last slide. So with regard to our positioning for the future, then going back to the premise that I started with, then asset management is increasingly competitive, but those with a differentiated strategy are set for a good future, provided that differentiation leads to strong investment performance. Our idea of a sustainable economy was somewhat a minority in terms of asset management sport 20 years ago, but today it's, I think, proving to be mainstream in the eyes of some of the world's largest owners of capital. Impax now has 20 years of track record with a stable team, which owns 30% of the business. And we have a number of products which have got great capacity for further growth. So we are very confident of being able to continue to grow over the next few years. I think I'm going to stop there and leave time for questions.
Terrific. Ian, thank you very much indeed. A lot of detail there. Any questions for Ian, please? Gentleman at the back, please, Chris, if you can get over.
The continents of South America and Africa don't appear to be on the investment list. Is there a reason for that?
Well, I think in Africa, sadly, the depth of the stock markets are really low, and there are almost no companies that we could consider investing in that are large enough and liquid enough for us to have a sensible proportion of shares. Hopefully that situation will change. In Latin America, we do own a small number of shares. I think we have one position in a Brazilian company at the moment. The chart I showed you is actually our distribution architecture rather than where we've invested. We don't have research in Latin America, and to be honest, that's the one area where I think our lack of language expertise across the team and lack of presence is probably an area that we could invest in the future. So that will be perhaps an area for us to go for in the next 4 to 5 years. In the meantime, we've had an office in Hong Kong for 12 years now. We've got a team of Chinese-speaking analysts who are doing a great job in uncovering underappreciated companies, not just in mainland China, but throughout the South Asia region as well.
Ian, you mentioned that asset management's a competitive and quite difficult industry for a lot of firms at the moment. A lot of people are experiencing pressure on fees. Do you have that coming across to you?
Well, I think with regard to fees, we've always proposed a straight asset management annual fee rather than performance fees. And that's generally been welcomed by clients, particularly in that sort of 2007 to 2015 period when everyone was recovering from performance fee structures that didn't really align interests. In terms of fee pressure, then generally speaking, we're not seeing any fee pressure on existing accounts, that people are happy paying as what they're paying. Where there's a bit of pressure is in certain countries around Scandinavia, the Benelux, where there's a lot of competition for global equity managers. And in the non-thematic equities area, where we're pitching something that's less differentiated, we're having to accept perhaps lower fees than we might have done, say, 5 years ago. But the flip side of that is that the volume potential is much greater. So there's a potential for bigger tickets, albeit at lower marginal fees.
Gentleman here.
Yeah, the slide you showed with the financials on it, if I saw it correctly, it looked as though the revenue number for the first half of this year had dropped from the first half of last year. I know the profits were up, but revenue dropped significantly. Was there a particular reason?
Yes, there was. In that period last year, we brought in a one-off carried interest payment from our private equity fund, which resulted in a special dividend that we paid in July last year. So that was non-recurring in the sense of we're not getting carried interest on a predictable basis. Now, we are halfway through the investment period of our current fund, which could well pay out carried interest in 2 to 3 years from now. But that's the reason that there was that
It
that
didn't
drop.
drop through to the bottom line, that, in the previous year.
I think it dropped through to the IFRS profit before tax. Yeah, I might have to take that offline just to go through the numbers with you, if that would be of interest.
Any other questions, please? Gentlemen here, please. Wait for the microphone, please.
How did the 24% of BNP Paribas shareholding come about? Was that a strategic investment by them, or was that in return for them being a distribution partner?
So BNP Paribas bought its stake on the secondary market in the end of 2007. By that stage, we'd been sub-managing a fund for them in Luxembourg for about 18 months, so the relationship was established. There was quite a big block of shares available through some historical culls, unsecured loan stock that we'd issued. And they had at the time a model where they wanted to take stakes in a number of differentiated managers. So at the time we agreed an MOU for distribution, they bought the shares, and at the same time we agreed a distribution MOU, which is effectively sort of European and Asian MOU, non-exclusive, and provides for coverage of, from our perspective, on the major countries where they've got strength. And it's been really, really beneficial. They represent about 30% of our revenues in the core mutual funds that we sub-manage for them, which is not too far away from the 24-point-something% of the shares that they own in terms of relative scale.
If an investor was looking to add a sustainable element to their portfolio for the first time, and they had a choice of investing in the management company, Impax Asset Management, or in one of your underlying funds or trusts, without giving financial advice, what do you think is the most efficient way to gain exposure to sustainability as a theme? Do you have any comments on that?
Well, I think I'm not a financial advisor, therefore the sort of amateur response to that is that it depends on your risk profile. You want exposure to a diversified portfolio of 50 or so companies globally that are in the sustainable economy, then an investment trust like Impax Environmental Markets would have a performance expectation that would be similar to the global equity market. If you wanted to get exposure to the opportunities for management fees from that sustainable economy opportunity, then of course the management company is a place to do that. Now, the correlation is much more likely to be a geared play on the market than it is just a beta equals 1 play on the market. So if the market turns south, our share price is likely to be falling more rapidly than the market falls. So I guess it's a sort of obvious point, isn't it? But
another question I had was, we read a lot about ETFs and passive, and you mentioned passive investing, and speaking recently to UBS, who are in continental Europe have got some very large and very fast-growing, sustainably focused ETF products. To what extent do you think that those passive vehicles are a threat to what you're trying to do? And further to that, I think you probably mentioned you're an active manager, but would you consider, as a firm, running some sort of passive strategies alongside your active funds?
So one of the secrets to our communication is to report our performance of the active funds against not just a MSCI All Country World Index, but against a basket representing the environmental sector. So there's a number of FTSE indices. And of course, we're trying to beat the environmental basket as well as the global index. And generally, we're able to beat the environmental basket. So I think we would be confident of being able to outperform an ETF, which would be based on some kind of environmental basket, and earn our fees. So our process is strong enough to do that in most market conditions. Would we launch ETFs ourselves? Well, I think the reason that we're unlikely to, outside the Pax World business, which already has a couple, is that we feel it would cannibalize the active management story. And if we were to present a distribution platform or a large pension fund with a choice of passive versus active, we would probably end up with more money going into passive, and we may actually get people switching from active to passive just because that headline of low fee is very compelling to a number of groups, large number of groups. So not likely to do that.
Any other questions? Gentlemen, just here, I think it might be the last one.
Could you tell us about the performance, of your fund management performance over the last couple of years? I know that before that it was very good, but an update, please.
Yeah, so let me give you two sets of numbers. So the global opportunity strategy, which is the one that St James's Place picked up at the end of last year, has been outperforming the market by about 300 basis points a year for the last 4.5 years. It had a very good 2018 when it was 500 basis points, 5% ahead of the market, because it was able to pick up very strong sector performance and good stock picking in healthcare and financials. In the thematic equity space, the environmental market space, last year, 2018, was pretty difficult, and we were behind by 200 basis points or so, because those industries, materials, technology, etc., were weak relative to financials and healthcare. So the thematic side had a poor 2018. The global opportunities had a good 2018. So I think we're feeling somewhat vindicated in having a new product, because now we're able to sort of hedge our revenue stream, if you like. Having said that, we've picked up, of the £887 million of net inflows, more than £800 million of that was in the environmental sector. So I think a lot of clients, institutional clients, saw the underperformance as a good time to be buying.
Ian, thank you very much indeed.
Okay,
Ian,
thank you.
Thank you.